This question tests what qualifies as revenue under IFRS 15, revenue from contracts with customers, and requires understanding of control transfer, principal versus agent, and contract liability, deferred revenue. Key points. Revenue must arise from ordinary activities of selling goods/services to customers. IFRS 15 requires separating performance obligations in a contract. Revenue excludes asset disposals, e.g., selling old motor vehicles. When acting as an agent, only the commission, not gross receipts, is revenue. If payment includes future services, part of revenue must be deferred, contract liability, and recognized over time. Long-term receivables may require discounting to present value under IFRS 15 plus IFRS 9. Principles. 1. Agency sales of $250,000, commission only. Repro Co. is an agent, not principal. It does not control goods/services. Therefore, it should recognize only commission income, not the full $250,000. Incorrect revenue treatment. 2. Sale of motor vehicles, $20,000. This is a disposal of non-current assets, not a customer contract. It falls under IAS 16, not IFRS 15, not revenue. 3. Sales $150,000 plus $30,000 servicing, correct. This includes 2 performance obligations, equipment plus servicing. Under IFRS 15, $150,000 relates to goods, current revenue. $30,000 is for future service over 2 years, deferred revenue. Proper separation and allocation makes this correctly included in revenue recognition structure. Correct answer. 4. $200,000 credit sale payable in 2 years. This involves significant financing component, 10% discounting required. Revenue should be recorded at present value, not $200,000 nominal. Incorrect as stated. Correct answer. Only option 3 is correctly included in revenue according to IFRS 15. This question tests IFRS 15 revenue recognition for long-term construction contracts, specifically the treatment of a contract asset/liability under the percentage of completion output method based on certified work. Key points. Contract price equals $5 million fixed price. Completion based on percent certified equals 38%. Revenue should be recognized using output method, certified work, not costs. Costs incurred equals $1.6 million. Supporting information only. Amount invoiced/received equals $1.74 million. This affects receivables/cash, not revenue recognition directly. Step 1. Revenue recognized. 38% times $5 million equals $1,900,000 revenue. Step 2. Compare with amounts billed. Invoiced equals $1,740,000. Step 3. Determine contract position. Revenue recognized $1,900,000. Amount billed $1,740,000. Company has earned more than it has billed. Contract asset arises. Difference equals $160,000 contract asset. Nil incorrect. Would only apply if billed equals or exceeds revenue, contract liability, or no balance. $160,000 correct. Represents unbilled revenue, earned but not yet invoiced. $800,000 incorrect. Likely confusion with cost-based calculation or profit estimate. Irrelevant under certified output method. $200,000 incorrect. Not derived from any valid step in IFRS 15 calculation. Final answer. $160,000 contract asset. This question reinforces a key exam rule. Contract asset equals revenue recognized minus amount billed when revenue exceeds billing. This MCQ tests understanding of consignment inventory, a special inventory arrangement where legal ownership and physical control are separated. In consignment, the manufacturer, consignor, keeps ownership, while the dealer, consignee, holds and sells the goods. The key idea is that the inventory is not sold until it is used or sold to end customers, so risks and rights remain largely with the manufacturer. Key points: ownership remains with manufacturer until sale occurs. Dealer stores and sells goods, but does not own them. Risk of inventory, especially obsolescence and slow movement, usually stays with manufacturer. Manufacturer may control or reclaim goods under agreement terms. The question asks for two indicators confirming consignment inventory characteristics. Manufacturer can require dealer to return the inventory, correct. This is a strong indicator of consignment. Since ownership remains with the manufacturer, unsold goods can be recalled. This shows control and ownership are not transferred. Dealer has no right of return of the inventory. Incorrect. This statement suggests a normal purchase arrangement, not consignment. In consignment, the dealer typically does not buy goods, so return rights are not the defining feature. Manufacturer bears obsolescence risk. Correct. Correct. Since ownership stays with the manufacturer, any risk of damage, slow movement, or obsolescence remains with them until sale. Dealer bears slow movement risk. Incorrect. In consignment, the dealer acts more like an agent. Therefore, inventory risk does not transfer to the dealer. Final answer: manufacturer can require dealer to return the inventory. Manufacturer bears obsolescence risk. These two correctly reflect the ownership and risk retention principles of consignment inventory.